Hello everyone and welcome back. In today's video we are going to discuss one of my favorite indicators, Bollinger Bands. And in this video I'm going to break down what exactly they are used for and the ins and outs and what to watch out for. If you like what you see here, please like and subscribe, and with that let's talk about Bollinger Bands. Let's quickly go over the definition. A Bollinger Band is a technical analysis tool defined by a set of trend lines plotted two standard deviations, positive and negative, away from a simple moving average of a security's price, but which can be adjusted to a user's preference. However, I like to go over a simple visual to make it easier to understand. There are two bands in a Bollinger Band, the upper band and the lower band. When the price action is sideways, it is tight and constrained, indicating low volatility. When the price action increases dramatically or decreases, this is high volatility. When a candlestick is above a Bollinger Band, this means it's overextended or overbought. Likewise, when we have a candlestick below a Bollinger Band, it's also overextended, but in this case it is oversold. Eventually, volatility will decrease and the bands will tighten and be constrained once again. There is a 20-day SMA that runs through Bollinger Bands. When the price action is above this 20-day SMA, that means it's bullish, and when it's below this, it means it's bearish. Now, let's look at some real-life examples. We're going to go ahead and start with cryptocurrency, everyone's favorite altcoin, some Ethereum. You can see at the recent price action, we did have some candlesticks that went above the Bollinger Bands, but you can see they quickly went back within the Bollinger Band. So anytime a candle is overextended, that usually means it's going to pull back into the Bollinger Bands. That includes both oversold or overbought. It's also worth noting that Bollinger Bands are very similar to the RSI. However, some people have an easier time using Bollinger Bands than the RSI, and it's easier to see in some ways because you see the candlesticks, and when it's above this band, you're likely to going to see a pullback soon. So this also helps with panic selling because you know it's going to most likely pull back and then hopefully continue uptrend. And you see that with the recent price action with Ethereum. If we go back, we can see around January 24th, we had candlestick above and then quickly went back in to the Bollinger Band. Let's find a little bit of a better example. Also keep in mind that 90% of price action stays within the Bollinger Bands. You can see here's a good example. Back on January 3rd, we got a huge overextension. It quickly pulled back, and it pulled back pretty hard. It hit the SMA and then bounced back. Got some wicks above the Bollinger Bands again and quickly pulled back. You can see that here too, little wicks going above the Bollinger Bands. You can see that the price action likes to stay within the Bollinger Bands. So again, if you see a pullback, don't freak out necessarily. It just means it's overextended and it's just calming down essentially. It's also good to see that if the price action is above the Bollinger Band, it's probably not a good time to buy. Again, going over when it's oversold, again, you can see that it was a little overextended and quickly went back in. So just because we see a red candlestick that's overextended and being oversold does not mean we should buy immediately, because you can see here if we bought right here thinking it's a good deal because it was overextended, you would have seen that it went down even further. I stress not to buy just because the red candle is overextended. That does not necessarily mean that it's a good deal, because as you see here, it went down even further. Now we're going to go ahead and look at Virgin Galactic, ticker symbol SPCE. Again, overextension and then a pullback. See a pullback. Pullback, you saw a little candlestick here, then a bit of a dip, and this was due, I would argue, to some market conditions, but we again see these wicks that went above the Bollinger Bands and quickly retraced back. Again, do not buy in these zones. When you see this, do not buy. I don't buy it, because then if you buy here, you would have had a nasty little dip here, then you might have probably would have panic sold and freaked out. Oh my god, my profits. So keep that in mind. It's a good rule to follow. Again, here is a good example. got overextended, quickly went back down within the Bollinger Bands. Also touching briefly on this SMA, I use the 6-day or 7-day SMA. This yellow line is the 20-day SMA, but whenever these lines cross, when the 7-day crosses the 20 and the 7 or 6-day SMA is above the 20, that usually indicates a bullish cross. Quickly look at here, we got on Blink, we got a bullish cross right here, the 6-day SMA with the 20-day SMA, and then we got a little bit of a run, and then we got a bearish divergence right here, and then we got a sell-off. Again, cross right here, bullish, boom, bearish, boom. You can see it lags a little bit though, because our selling confirmation was here and not there. Some people use the 7-day SMA and some others use the 21-day SMA. It depends on how aggressive you want to be in buying and selling. Well, that about wraps up Bollinger Bands. If you like what you've seen here, please like and subscribe. Thank you for watching, and until next time.